Have you ever found yourself maybe staring at your bank balance or thinking about a big purchase like a house or a car and just wondering what on earth is actually going on with the economy?
Yeah, are rates going up? Down? Is my money okay? Those questions hit close to home for everyone, don't they?
They really do. They shape, all our financial decisions.
Yeah,
And figuring it all out feels like you need some kind of secret decoder ring sometimes.
absolutely. Or maybe a crystal ball, the signals from central banks, from the markets. It's a lot to track.
Well, you're in the right place. Welcome to the deep dive. Today, we're going to try and cut through some of that noise. We've got a really fascinating source here, the latest Macro Butler special service newsletter. It's called Frozen Rates, Flowing Liquidity Ahead.
Right. And our mission today is basically to peel back the layers of this report. And let me tell you, it doesn't pull any punches. We're going to look at what it says is really going on with the Fed, with the markets, the economy.
Think of it as your shortcut, maybe. A way to grasp this complex dance between policy, debt, and, well, your wallet.
And this report, it starts off with a bang, challenges the usual thinking right away, especially about the Fed's last meeting.
Yeah, it's punchy, direct. Got some surprising insights. So let's get into it.
Okay, so first off, as pretty much everyone expected, the FOMC, that's the Federal Open Market Committee, they basically hit the snooze button again.
Right. Fifth meeting in a row.
Fifth meeting, kept interest rates steady. Target range is still 4.25% to 4.5%.
So Powell and Co. are firmly in wait-and-see mode, as the report puts it. Like they're looking at the economic data as if it's what was the phrase? A malfunctioning magic 8-ball.
Huh. Yeah, that captures it. And it's not happening in a bubble, right? The report mentions the global chaos, tariff tantrums to actual wars, adds layers of complexity for the Fed.
Definitely complicates things.
But here's where the report highlights something really interesting, a big twist.
Okay.
For the first time since 1993, so quite a while ago, two Fed board governors, Waller and Bowman, actually dissented. They disagreed with keeping rates steady.
Wow. Okay. 1993. That is a long time. So a dissent like that, it breaks the mold. The report calls it a break from decades of groupthink.
Exactly. It's incredibly rare. Makes you wonder what's going on behind the scenes. Some friction maybe?
Yeah, it certainly suggests the wait and see isn't quite as unified as it looks on paper.
Does the report say why they dissented?
It doesn't spell out the exact reasons, no, but the act itself speaks volumes. It signals maybe a deeper divide on where things should go next.
Interesting. And there was more. You mentioned the statement itself.
Right, yeah. On top of the dissent, the official FOMC statement actually sounded a bit more dovish,
Yeah.
softer than expected. Two key changes in the wording really stand out.
Okay, walk us through those, because sometimes those tiny word changes from the Fed, they tell you a lot, don't they?
They really do. So first, they used to say, economic activity has continued to expand at a solid pace.
Mm-hmm.
That got changed to something more cautious. Growth of economic activity moderated in the first half of the year.
Yeah.
So it's an acknowledgement things are cooling off. Okay, moderated, a definite shift. What was the other one?
The other one was about uncertainty. They previously said uncertainty about the economic outlook has diminished but remains elevated.
Right, I remember that.
Well, they chopped off the first part. Now it just says uncertainty about the economic outlook remains elevated.
So they took out the bit about uncertainty diminishing, kind of dials back the optimism, maybe reintroduces that caution.
Precisely. It feels like they're tapping the brakes on sounding too confident. And amidst all this, they also cheerfully, as the report puts it, announced they're keeping up the balance sheet trimming.
Ah, yes, the quantitative tightening. Still ongoing.
Still ongoing, $5 billion a month. The report has this great image for it, calls it tiptoeing away from a $7 trillion mountain of IOUs with scissors and a prayer.
That's vivid. Scissors and a prayer.
It paints a picture, doesn't it, of the scale and maybe the precariousness of it all.
So you've got dissents, softer language, but still trimming the balance sheet, and then Powell's press conference. The report suggests he tried to sound tough, maybe for those dissenters.
That's the suggestion, yeah. He reportedly tried to sound tough, but the actual policy statement was still, in the report's words, soft and cuddly.
A Fed compromise, they called it.
Exactly. He did throw out some hawkish lines, though. Said tariffs were squeezing business margins, not hitting consumers directly with inflation.
Okay.
And he acknowledged Labor market risks are certainly apparent. But still, the report argues the underlying message, the policy itself, stayed pretty dovish despite the tough talk.
Right. So the Fed makes its move. We see these internal dynamics. What did the markets make of it all? How did they react?
Well, that's the interesting part. Maybe surprisingly, the reaction in U.S. stock indices was pretty muted, just modest moves.
Really? Not a big swing either way.
No. NASDAQ did a bit better than the S&P and the Dow, but overall pretty calm. And the report makes a really important point here, which that market actions seem to be driven more by individual company earnings reports this time around rather than just the Fed announcement itself.
Ah, okay. So a reminder that it's not always just about the Fed. Company performance still matters.
Absolutely. Now, looking at rate cut expectations, those did shift. Money market traders reacted to Powell's hawkish tone even if the policy was softer.
So they dialed back the odds of a cut.
Yeah, they trimmed the odds of a September rate cut down to 47%. That's quite a drop from over 60% before the meeting and way down from 71% after Jackson Hole meeting earlier.
47%. So less than a coin flip for September now.
Right. But, and this is key, the report says traders are still clinging to the soft landing fantasy.
Still hoping for that gentle slowdown, no recession.
Seems like it. They're still pricing in 2 cuts by the end of the year with about a 44% probability. So expectations are adjusting, but that hope, that sort of baseline optimism, it's still there.
Interesting psychology. Why do you think that fantasy, as the report calls it, is so persistent?
Well, it's probably a mix of things. Natural optimism, maybe a belief the Fed will step in if things get really bad, maybe just reluctance to price in a really tough scenario.
Makes sense. What about other assets? Dollar, gold.
The dollar actually got stronger. It surged after some strong Q2 GDP numbers came out. Plus, Powell's hawkish talk really dashed hopes for a September cut, according to the report.
Okay, stronger dollar. And gold.
Gold was doing what the report calls a sideways shuffle, just kind of treading water. But the report has a very strong opinion on gold.
Oh, yeah.
It basically says investors are being slow to grasp a basic truth, which is that in an inflationary bust, it's gold, not stocks or bonds, that really protects your wealth.
Pretty bold claim there.
Yeah.
Ditching stocks and bonds for gold in that scenario.
Very bold. And it also points to the U.S. 10-year Treasury yield. That's a really key rate for long-term borrowing.
Right. Affects mortgages, corporate debt.
Exactly. It's been consolidating, kind of hovering above a technical level. The 61.8% Fibonacci retracement, around 4.34%.
Okay, technical levels.
Yeah.
Sometimes they act like magnets or barriers.
They can, yeah. And the report's conviction here is clear. It thinks it's just a matter of time before we see much higher long-term yields. It argues the whole idea of a risk-free rate is basically dead. No more free of risks, as they put it.
Wow. So higher borrowing costs baked in, according to them.
That's the takeaway. Which brings us neatly to one of the report's main arguments. This idea about the Fed's actual power.
Right. They say Wall Street still treats the Fed like an all-knowing oracle.
But reality keeps crashing the party. They use this analogy, comparing Fed rate cuts to ringing the dinner bell for the bust cycle.
Ringing the dinner bell for the bust? How so?
They point to the ratio of the S&P 500 to the price of oil. Apparently, when the Fed starts cutting, that ratio often dives like a kamikaze seagull. It's a stark image suggesting rate cuts don't always lead to good times.
A kamikaze seagull. Okay, so this raises a big question for you, our listener. What does this mean practically? The report makes a distinction, right, between short-term and long-term rates.
A crucial one. It argues the Fed just twiddles with short-term rates, almost like it's a game. But the real economy, that runs on the long-term stuff, the 10-year, the 30-year yields.
Those are the rates that actually impact buying a house, getting a car loan, a business deciding whether to expand.
Precisely, the big decisions. And here's the kicker. The report claims the Fed has about as much control over them as it does over the weather.
Wow, that's blunt. So limited power over the rates that matter most for the real economy.
That's their argument.
Yeah.
And it connects directly to government spending. They say, look, fiddling with short rates doesn't really tame inflation when, and I quote, Uncle Sam is out there binge borrowing like a teenager with their first credit card.
Huh. Okay. So massive government borrowing makes the Fed's job much harder, maybe even impossible.
It complicates it massively. When the government itself is creating so much demand through borrowing, it fuels inflation in a way that tweaking the Fed funds rate can't easily offset. You can see this in charts like the U.S. total public debt versus GDP. It's just climbed and climbed.
Right. And the report suggests the Fed isn't really focused on that huge issue.
It argues they're getting distracted. That instead of tackling the government debt issue head-on, Fed members chose to wring their hands over tariff tantrums and immigration headlines.
Which leads into this whole discussion about how we measure the economy, right? Using GDP.
Yeah, this part is fascinating and definitely critical of the standard metrics. The report mentions a Dallas Fed study.
Okay.
This study estimated that mass deportations could actually reduce GDP quite a bit, like 0.8% shaved off for deporting 2.4 million people in 2025, maybe even 1.5% by 2027 in a bigger scenario.
Huh. Reduced GDP. That sounds counterintuitive to some, maybe.
It does, and the report argues why it sounds weird is because of the utterly deranged way GDP is calculated.
Utterly deranged. Strong words. What's their specific beef with the calculation? We all learned C plus I plus G plus XM.
Right. Consumer spending, investment, government spending, net exports. The critique zeroes in on the G government spending. The argument is that any government spending, no matter how it's funded or how productive it is, just gets added to GDP and counts as growth.
So spending is spending, basically. Good or bad, it boosts the number.
That's the critique. They use the example of New York City spending billions on migrants. I think it was $12 billion projected by mid-2025. Under the current GDP rules, if you cut that spending, it would technically hurt the GDP number.
Even if taxpayers felt relieved, wow, that definitely makes you think about what growth really means.
It does. And this ties into the political blame game. The report suggests, okay, when stagflation hits, the swampy chorus will blame whoever's in charge. They mention the disruptor in chief. But the report argues people who study business cycles know the train was already headed for a bust well before the conductor changed.
So arguing for a more cyclical, less political view of downturns, that the seeds were sown earlier.
Exactly. It suggests these cycles have their own momentum, somewhat independent of who's in the White House. It pushes back against easy political blame.
Which leads to a pretty stark warning in the report about political meddling.
Yeah, it warns that this kind of thing, political pressure, is dragging the U.S. closer to the Banana Republic playbook.
Banana Republic playbook, that's not good.
Yeah.
What's the comparison they're drawing?
They point to examples like Turkey or Brazil, where political interference with the central bank in emerging markets often leads to chaos of, spiraling inflation, collapsing credibility.
Whereas countries with truly independent central banks tend to be more stable.
Right. So the fear implied here is that if the Fed loses its independence to political pressure, the U.S. could face similar instability, a serious risk to financial credibility.
Okay. So a lot about the Fed, government politics, but then the report shifts gears again, right?
Yeah.
To what it sees as the real driver.
It does. It makes this provocative claim. It's not the Fed funds rate that really moves the markets. It's the Fed's secret stash of shadow liquidity pulling the strings behind the scenes.
Shadow liquidity. Sounds mysterious. What exactly is that?
It sounds like it, but they define it. They point to something called the USD Liquidity Proxy Index.
Oh, okay.
It's basically a combined measure. It includes the Fed's balance sheet size, the amount of cash the Treasury holds in its account at the Fed, the TGA or Treasury General account, and also the money parked in the Fed's reverse repo program.
So it's a broader measure of available dollars in the financial system.
Exactly. And the key point the report makes is that this index, this measure of shadow liquidity, is once again inflating. It's going up.
And why is that so important for markets?
Because, as the report puts it, swelling USD liquidity is basically the financial market's favorite wind at their back, especially for equities.
Ah, like fuel for the fire.
Pretty much. They show how the S&P 500 and the change in this liquidity measure tend to move together like they're joined at the hip.
So the implication is, the recent stock market rally might not just be about good company earnings or a strong economy.
That's the strong implication. It suggests it's heavily influenced, maybe even primarily driven, by investors drowning in liquidity. They even say it fuels things like the meme stock mania.
Right. So if liquidity is the main driver, maybe more than fundamentals,
Yeah.
what does that mean for valuations? Are prices potentially inflated?
That's the logical conclusion, yeah. If performance is more about liquidity sloshing around than actual economic health or company value, then traditional valuation metrics might be misleading. Prices could be artificially high.
Which leads us to investment strategy. Because the report is pretty brutal about the old ways of thinking, isn't it?
Oh yeah. It declares Keynesian theories crumble and says the old 60-40 portfolio is fast becoming a Wall Street museum piece.
Museum piece. Okay, so the classic balanced portfolio of 60% stocks, 40% bonds. Dead. Why? What's wrong with Keynesian ideas now, according to them?
Well, they argue those traditional models, often focused on government spending to boost demand, just aren't working anymore. They say we've moved past simple financial repression, where low rates slowly erode savings, into what they call full-blown monetary inflation, meaning the money supply is expanding so fast through government borrowing and Fed actions that it's actively, obviously, devaluing the currency, not just a subtle thing anymore.
And that's why the 60/40 portfolio fails, because both stocks and bonds get hurt by that kind of inflation.
That's the core argument. In that environment, traditional diversification doesn't work as well. So if that's the diagnosis, what's the prescription? What does the report say you should do with your assets, especially if you believe this inflationary bust is coming?
Right. Well, the guidance is pretty clear. In that scenario, they see bond collapsing. But real assets like gold, prime real estate, and commodities thrive.
Real tangible stuff. Okay. What about stocks?
Stocks have a sweet spot if inflation is moderate, they say. But if it keeps climbing, only large caps with pricing power, companies that can raise prices without losing customers, can hold their ground.
So focus on quality pricing power if you're in stocks. Makes
Right.
sense.
Yeah. The overall message is stark. Ditch the old playbook, load up on inflation hedges, and prepare for the storm. They state it flat out. The U.S. isn't heading for disinflation. Nope. Stagflation's knocking at the door.
Stagflation. High inflation, low growth. Not a pretty picture. And they blame things like looming war, fragmenting global trade, tight commodity markets.
Yeah, tighter than your last pair of jeans was the phrase they used for commodities.
Huh. Okay. So given that gloomy outlook, what specific portfolio advice do they offer, like actual percentages or types of investments?
They do get specific. They advise allocating 30–50% of their portfolio, which is a huge chunk, with physical gold and other precious metals such as silver, platinum, palladium, and key commodities, things that are battle-tested and sovereign-proof.
30 to 50% in hard assets and commodities, that's a major shift from traditional allocation. What about the equity portion?
For equities, the advice is tactical. Deploy capital into low-leverage firms with strong EPS and free cash flow, companies with solid balance sheets and good earnings. And they add a timing element. Quote, strike when energy producers dip, retreat when energy consumers rally.
So playing the cycles within equities, focused on financial strength and energy. And defense stocks.
Right. Given the global conflict risk, they say aerospace and defense stocks become strategic positions.
Oh, okay. And bonds. We know they don't like them much.
Avoid the long-term government bonds. Too slow and too exposed. Instead, if you need bonds, stick to short-term, investment-grade corporates maturing within a year. Keep it short, keep it high quality.
Got it. And overall return expectations. Should people expect big gains with this strategy?
Nope. The report ends that section with a warning. Investors should also remain prepared for dull inflation-adjusted returns in the foreseeable future. Even with this strategy, beating inflation might be tough.
So a challenging environment ahead, demanding a very different approach. To kind of wrap things up then, the core message from this Macro Butler report is pretty damning for conventional wisdom.
It really is. It basically says the Fed's theories are broken. They ignore crucial factors like global money flows, debt, public confidence.
And it doesn't hold back on the conclusion. It asserts the Fed's impotent moves won't stop the U.S. from sliding into Trump stagflation. That's a specific, pointed phrase they use.
Yeah, very pointed. It's a call for a whole new approach, really. One rooted in the business cycle, led by market practitioners, not, as they say, theorists playing dress-up.
So hopefully for you, the listener, this deep dive has helped illuminate some of those hidden mechanics. To see how, as the report cheekily puts it, economics struts around pretending it's a hard science, but it's really just spreadsheet fortune-telling.
And we'll leave you with this final, really thought-provoking analogy from the report. Something to chew on. They say, if they bothered reading Joseph's story, yes, the guy with the fancy coat and Pharaoh's dream, they'd get it. 7 fat years, 7 lean years, save when you can, brace for the storm.
It's not rocket science, they conclude. It's income harvesting with a calendar. Understanding the cycles.
Maybe the final thought is this. The report suggests the day the central bankers-in-chief finally get the cycle
Is the day they realize just how little control they actually have. And perhaps understanding these cycles yourself is the first step toward navigating whatever comes next. Definitely